Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 222nd VideoCast podcast for the week ending July 18th, 2024. We'll do some quick family stuff, and then we'll get down to business. First off, want to congratulate my eldest daughter, Mimi, who was at Olympic Development Program Super Regionals and actually got photographed for the official USA Water Polo Instagram account. So that was pretty exciting. And then Annabelle, while Mimi and I were in Dallas, and great to meet a couple of you, very exciting. Annabelle was at a swim meet in Princeton, and let's see, it was the Princeton Invitational at 9 years old. Out of 102 swimmers, she won both the 12 and under 50-yard freestyle and the 12 and under 50-yard backstroke with quadruple A times. She went 27.62 in her 50 free, and her new best time in the 50-yard backstroke is 31.26. She's ranked number one in the nation right now for 9 and under in both events. So pretty exciting weekend for her. Was sad to miss that in person, but we got to divide and conquer there. Dallas was amazing. So that was the Instagram, and there's Mimi again and some of her teammates. That's her amazing coach, Hannah, who was the USA Water Polo coach for the Northeast region. Super exciting. That's another one of memes. And then, a couple more. Then we went to see these, I don't even know what they're called. Asiatos or Axoletos or something. Anyway, someone will correct me. They always do. That was what she wanted to do. Asoletos or something. And that's an overhead shot of her amazing team after they won on Sunday, by the way. They got off a little shaky first couple of games, but then they just built as they learned how to play with each other. Asoletos, here's another one. And then they just really gelled together by the third. And then the fourth game, they just blew out the competition. I think it was 18-8. And this right here was probably the most exciting 15 seconds of my 2024 so far. That's Mimi. So I was super excited. All the other parents were looking at me like, sit down, you schmuck. But nonetheless, that's the way it goes. I want to thank Kristen Scholler and Rachel Pyer for having me on Cheddar today. This was a great overview of geopolitical markets, everything outlook. We're going to listen now.
Today, I want to bring in Thomas Hayes, Chair and Managing Member at Great Hill Capital LLC. Thomas, good to see you. Happy New Year.
Happy New Year. Great to be with you, Kristen.
All right, so let's get straight to it here. What is driving the market now? What does it mean for investors?
Well, there's a little bit of caution. You know, the market moved very aggressively into year end, and people came into the new year thinking that there was going to be this overwhelming amount of tax loss selling, and it was time to get immediately short. And I think you have to be cautious with that point of view. It's rooted in recency bias. If you zoom out a little bit, Kristen, what you'll see is that actually the stock market has made zero gains in over 2 years. So we had the huge move off the COVID lows into 2021. But since that peak in 2021, the market's been consolidating sideways for 2 years and just now starting to break out to new highs. So it would be normal to get a little bit of volatility and a little bit of consolidation after a big year. But when we look at election years since 1928, the average returns are 11.28%. And when you have an incumbent president running for re-election, they're 13. So I do think that even if we get a little chop, we do have nice upside into year end.
How is this impacting your investment strategy, Thomas? What are you buying and selling as we start the new year?
Well, I think that the gains last year were largely driven by the Magnificent Seven. The rest of the market started to participate in the second half and particularly in the fourth quarter. So I do think the Magnificent Seven, if you look at the Bank of America Fund Manager Survey, that's the most crowded trade. And if you think that the indices returns are going to be more subdued, high single digits, low double digits like we do, That implies that the Magnificent Seven will probably underperform relative to next year. Forward earnings on that group are well over 20 times if you look at the S&P. But the mid cap and small cap indices are trading at about 14 times forward earnings. So there may be some opportunities there. If you look at the fund manager survey from yesterday, what you also see is managers are underweight by 0.2 to 1.1 standard deviations relative to historic levels. Underweight banks, real estate, commodities, UK equities, and energy. So there are some selective opportunities there as well.
I do see jobless claims. Those are the number of Americans filing for unemployment benefits on a weekly basis. Actually, Thomas, dropping to their lowest levels since September of 2022. We've got housing market data today. What is the economic data signaling to you in terms of the strength of the consumer?
Goldilocks. We had great retail spending. We did have, this is a good jobless claims report, but we have to keep in mind the non-farm payrolls reports, 10 out of the last 11 months have been revised down. The cumulative downward revisions have been 500,000. And then if you look at core PCE annualized, the inflation rate is right around the Fed's target at 2%. So I don't think the Fed can stay restrictive too much longer when you consider the Fed funds rate at 525, 550, and the core PCE annualized around 2%. That's 300 basis points of restrictive policy. I would not be surprised in the January meeting if they actually started to talk about tapering the taper or stopping the sales of bonds on the open market. And that would be a welcome respite for the market. And then rate cuts maybe starting in March or the meeting thereafter. But they've been tightening and restrictive for some time now, and they have to be cognizant of the lag effect because inflation is a much easier problem to solve than deflation.
Yeah, that's good to note there. So the Fed had forecast 3 rate cuts this year, Thomas, at its final meeting in December, the last meeting that we've heard from the Fed with a policy decision as well. Do you think that makes sense for this economy? And if we do get those rate cuts, when do you expect that they might start?
Yeah, I would. The prudent thing to be, the earlier they start, the less cuts they'll have to do. So the prudent thing to be would be to start at least by March. And if they do so, I think they're right on target. It may be 2, 3, maybe 4 cuts should be sufficient. If they wait because he's afraid of this Arthur Burns analog, which is completely non-comparable to the current circumstances, if they wait too long, then they might have to do 6 or 7, and they might actually force a soft recession. So earlier is better. You can always walk back if the economy heats up again. But if they go late, then you really do run aggressive disinflation risk and aggressive slowdown risk.
And I think probably investors may be agreeing with you, Thomas, as we do see the NASDAQ outperforming today up 1% as the Dow does tick lower. Yes, of course. We are in earnings season. Earnings continue to come in here. But of course, we know that the NASDAQ would benefit, has historically benefited from lower rates and that index rising a whopping 42%. Just last year alone. When it comes to the earnings picture, any takeaways that you're getting from corporate America so far?
Well, the secret to happiness is low expectations, Kristen. I thought the bank earnings were okay. But if you look at September 30th, the expectations were for 8% earnings growth for Q4. They came down to 1% earnings growth. So this is not a bar that needs to be jumped over. This is a bar that will be easily stepped over. And I think as we get further into earnings season, we're going to see continued upside surprises, which should give us a little more juice in late January and early February. And if we do move meaningfully to new highs on the S&P, that's when I'd start to be a little more cautious for a pullback in maybe March or April time period before starting out the year-end rally. Year-end move into year-end.
Let's just talk about some of these geopolitical factors as well, Thomas. What we've been seeing playing out in the Red Sea, obviously the ongoing war in Ukraine and the Middle East now as well. What are the risks that investors need to know?
Well, there's always geopolitical risk, and that's something you can't control. What you can control is buying high-quality companies that have durable, sustainable cash flow growth. at reasonable prices and just holding through the geopolitical noise, which is always going to be there, and you have absolutely zero control. I guess the key is if you're buying right, try to put that out of mind, because more often than not, the fear of the outcomes are worse than the outcome, and it takes people out of stocks and out of great companies at the exact wrong time.
All right. Thomas Hayes, thank you so much for joining. Thomas is a chair and managing member at Great Hill Capital.
And we're back. So that gives good context to how we're thinking about things. Want to thank Anyana Miriam Rajesh for including me in her Reuters article this morning. And the Warren Buffett quote of the week: the stock market is a no-called strike game. You don't have to swing at everything. You can wait for your pitch. The problem when you're a money manager is that your fans keep yelling, "Swing, you bum, swing." So we're going to talk about that in the context of the Ask Me Anything questions this week. And I think those of you who have been listening for a while know that a lot of times you'll present good ideas and I'll just pass, because the longer you're in the business and the more you understand it and the more successful you become, the more you realize doing less is more. It's the exact opposite of every other business. You make big money by doing nothing after you've bought high quality businesses. You play the time arbitrage game versus keep pulling up the seeds and never let anything grow to the sky. And that's what a lot of people do. Also found this chart very, very interesting from Bank of America. Thanks to my buddy Adam, you know who you are. And this is dividend yield is unloved by active funds. And you can see how it's fallen out of favor, and relatively inexpensive versus history. So dividend yield stocks have the lowest forward PE than they've had since the 2001 and 2002 lows. And if you have been listening for some time, you'll know that we've been drawing quite a few comparisons to this period to 2001 through 2007. And if you recall, what dramatically outperformed from 2001 to 2007, emerging markets as the dollar weakened. Number one, emerging markets in China. But number two, small caps, which we've talked a lot about. And number three, which this is new to me, is dividend yielding stocks. And what's also really exciting about that is that basically they took off as the easing was happening, the cuts were happening. But what's interesting is we naturally gravitate to where there's opportunity, where there's dislocation. And I was going through a number of the stocks that we've discussed on the podcast in recent months, and a number that are in some client portfolios, and some are and some aren't. But just going through, I was like, the common theme is we have a lot of high dividending stocks, not because we're looking for dividends, but because that's where the greatest opportunity was. And you can see that we're right at these levels where they start to take off, and that would be natural. It's similar to what we talked about with REITs and utilities last year and everything else. But Citi's got a 4% yield. Bank of America's 3% yield. VF Corp 2.4. Stanley Black & Decker 3.5. 3M 5.6. Hormel 3.6. Disney's only 0.66. CCI Crown Castle 5.77. Baxter 2.84. Comstock Resources 6.17. Advanced Autoports, and so on and so forth. So you recognize a lot of them names. The common denominator is we picked them up not because of the dividend. We're getting the dividend for free, but because that's where dislocation, it makes sense. This is where dislocation is, because that's where it is also for small caps, also for emerging markets. And that's when we pounce. When everyone's running outside, we're running back in and picking up all the money left in the theater. And that's exactly what's taking place with this particular group. Nick Timiraos, the Fed Whisperer, put out something this afternoon, which it's funny because not only did I cover it on Cheddar, but I also covered it. I had a special interview with David Lin, which will probably be part of next week's podcast VideoCast, which was, a 30-minute interview. Everyone loves his interviews as well. And basically what Nick is saying, who is the Fed Whisperer, is that the December CPI and PPI core PCE is projected to have been mild last month. The modelers who forecast this expect core PCE rose 0.17 from November. This would lower the 12-month rate to 2.9. However, the 3 and 6-month annualized rates would fall to 1.5% and 1.9% respectively. This is what I was talking about, the Fed being 300 basis points plus too restrictive, and this would give them cover to go sooner rather than later. So straight from the horse whisperer's mouth. Here's from Seth Golden. This is, he posted this chart from the Leuthold Group, and he says, rare to see insider net sales at such depressed levels when market has made a 52-week high. Number of insider block sales is near a maximum buy signal threshold of 1%. You can see each time that the insiders were this low on net sales, you were at major inflections, and here we are over and over with with one exception actually. The rest of the times were monster buy opportunities, and I think this one will prove to be a similar situation. So the City Never Sleeps stock market and sentiment results on Tuesday. I joined the Money Show virtual accredited investor conference to present Turnaround Tom's top picks and outlook for 2024. Thanks to Mike Larson, Debbie Olson, and Shelley Coyle for having me on. We are going to view this because it really lays out the entire playbook for the year with 3 of my top picks. And you can click here for the accompanying slideshow. So we're going to get started here.
Good morning. Welcome, everyone. Thank you for joining us. Without further ado, it is my pleasure to introduce Thomas Hayes. He's the founder, chairman, and managing member of Great Hill Capital. To our live viewers, if you have any questions for Thomas, please put them in the chat box. Time permitting, we will get to those at the end of his presentation. And with that said, Thomas, I'll be right here if you need anything, and the floor is all yours.
Thanks so much, and welcome everyone to the Money Show. Very excited to be here. As you can see, our presentation is called Turnaround Tom's Top Picks and Outlook for 2024. And I got that nickname because I really like to be in companies that are high quality companies that have durable advantages, but are meaningfully out of favor with some catalysts to turn around. So I've gained that nickname over the years, and I think you're going to see why as we go through the presentation. But a little bit about my background first, because you not only want to listen to my opinion, but actually know why it may or may not make sense to listen to the speaker's opinion. I do have over a decade and a half in the hedge fund world and in the hedge fund business. I'm a long-short equity manager. We focus on quality value as kind of our knitting. You can see me regularly on Fox Business, some of the CNBC stations, Yahoo Finance, BBC, etc. Prior to starting my own firm with Great Hill Capital, I was with a firm that many of you may know called Cornwall Capital. They were featured in the movie The Big Short. I worked for the gentleman that is played by Brad Pitt. He's known as Ben Rickett in the movie. I would say he is much smarter in person and not quite as handsome as Brad Pitt. And I think he would agree with both of those assessments. And then prior to that, the first hedge fund I was at, Bedford Oak Advisors, we had a portfolio company that I was actually inserted as the chief operating officer of the public company. And my job was to go in, sell off the non-core assets, and then use that cash to source, negotiate, and close the purchase of an asset management firm. And what was valuable about that was I interviewed over 100 different firms, and I got to see which strategies worked, which were durable, which stood the test of time, and ultimately sourced, negotiated, and closed the purchase of an asset manager with over $1.6 billion under management. So got a lot of experience with that. And then attended Columbia University. Now, Great Hill Capital runs a long-short equity strategy in separately managed account format for accredited investors and qualified institutions. We have developed a reputation over time for benefiting from sector, stock, and general market dislocations in periods of distress. And you're going to see with some of the names we present today that we definitely like distress. We also do a weekly podcast VideoCast for free, which is top rated in the hedge fund category. It's been toggling back and forth between the number 1 and number 2 spot for feed spot. We've been going for about 3 or 4 years with that, 222 episodes now. The podcast is called Hedge Fund Tips with Tom Hayes. And over time, that's how we've got quite a few of our clients that weren't referrals from friends or existing clients. They listen for, several months or a year or more in some cases. They make money off the ideas, and then they're like, here, you manage it. And we like that strategy. So I think you'll get a lot of value whether you become a client or you don't. Our strategy simplified. We make our money buying on weakness and selling on strength. That's easier said than done. A lot of people like to buy on strength what's already up. I think over time, you'll see over decades that the idea of buying when things are out of favor will outperform. And then you'll get some short periods where buying momentum actually works better when money is free and rates are low. But as we see a rate normalization, this strategy has started to really come to the forefront, and stock pickers are doing exceptionally well. Our confidence to step in when others are bailing is rooted in deep research and the premise that the more price becomes dislocated, the more risk that has actually come out. What is the first thing you hear people say when a stock is down? Oh, that stock is falling. That's really risky. Well, no, it was probably risky when it was trading at 2 standard deviations above its historic multiple, and everyone was chasing the last few ticks. Actually, when you have a business that is down, but cash flow is stable, growing, durable for a high quality business, those are generational opportunities. And finally, most participants see increased volatility as increased risk. We view it as increased opportunity. So we hope that we can impart that kind of framework to you today, and hopefully that will add some value to your investing process. We didn't invent anything. We just copied the best in the world. Warren Buffett has had an enormous influence, obviously, with Charlie Munger, and then Buffett's mentor, Ben Graham and Dodd. Great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. And I think the key here is excellent companies are surrounded. Some people just buy stuff because it's way up or because it's way down, and it takes no consideration as to, well, is it generating free cash flow? Is that free cash flow growing or is it declining? Why? Is it a temporary impairment? Is it a permanent impairment? What is the solvency risk? How does the balance sheet look? And these are important questions before stepping into something just because it's down a lot or just because it's up a lot. And we'll get into that today as well. But first, let's get to the big picture, because everyone always wants to know, is the market going to go up or down? And the answer is, I can't tell you what's going to happen in the next 2 days or the next 2 weeks or the next 2 months. So don't log out. But I can give you some ideas of how we think about the next few years and the greatest opportunities there, and particularly in 2024. But this is a framework from Robert Slumer that we started talking about in 2020 before he published this beautiful graphic that coincides with exactly the way that we're thinking about where we are in the long-term secular cycle. And what the case that Robert makes here from RBC is that the generational cycles last on average about 16 to 18 years. It's driven by demographics. And if you go throughout history, the countries and economies that do exceptionally well tend to have a large portion of their population age 32, 33, all the way up to 40. And by the time that bulk of the population hits 40, their consumption starts to decline. And if you think about housing and family formation, you move out to the suburbs, you buy the house, you buy the car, you buy the stroller, you buy the crib, you buy the washing machine, you buy the refrigerator, you buy the extra car. And that's what happens in these periods here of reflation and beyond. And then these periods here, like most recently, we had basically a lost decade and a half in the 2000s after the 2000 peak. Part of the reason for that is my generation, Generation X, you went from 80 million baby boomers getting up, over 40 in 2000 to drop down to 65 million Generation X, which was a very small generation. And that's why the Fed was able to print so much money over that period and not create inflation because the demand was so low from such a small population in their 30s and 40s starting housing and family formation. And now we have the millennials reaccelerating, average age 33, 34, and Gen Z behind them, which gives us runway for another 10 years. And we think dips are to be bought from now through early 2030s. And that doesn't mean we won't have normal. The average drawdown each year is 14%. So normal 8 to 10% pullbacks, some 20% corrections along the way. But the general secular trend is up until the millennials and some of the older Gen Z start to turn 40 and the consumption slows and we move more into a sideways period like we saw in the 30s and 40s, in the late 60s to the late 70s, and in the 2000 to 2015. So kind of stepping back and looking at where we are in that cycle. The other thing to keep in mind, a lot of people are saying, like, we have to correct and have a big crash now because we had such a big run the last 9 weeks of 2023. But if you step back and look in perspective, we have had 0 stock market gains for the last 2 years. You can see that we peaked out in late 2021, and we're just now starting to break out to new highs. What you can see here historically is after you've had big rallies off of hard lows like we had in October 2022, when many people were saying stay out of the stock market. We had a huge rally here, and while we have moved a long way, like all of these other 2-year consolidations off of big rallies, the 2009 rally, when they break out, yes, they can check back and retest. Yes, they can check back and retest, check back and retest. But they tend to proceed multi-year durable rallies for 1 to 2 years following the breakout. The exception would be the 2009 breakout only lasted about 6 months and went about 25%. And then we had COVID. So if you are betting on another once in 100-year black swan, then I guess you wouldn't want to be constructive here. But if you're betting that it's going to be more like 99 out of the last 100 instances of 12-month periods, then, breakouts are generally bullish, and you want to be selective and buy those quality companies that maybe didn't participate quite as much in the last 9 months or off the 2020 lows. So obviously you had major tech outperformance, FANG outperformance. We think they continue to perform, but maybe more in line with the indices. And what do we think about the indices for this year? Well, we know it is an election year. And since 1928, election years on average are up 11.28%. We would expect to see high single digit, low double digit growth in the general indices, and a lot more opportunity and a lot more upside under the surface, particularly in maybe those names that didn't have all of the outperformance over the last 16 or 18 months, which would be non-FANG. FANG, by definition, if the indices are up, call it 10%, FANG will have a decent year. The Magnificent Seven will have a decent year, high single digits, low double digits, but the real outperformance can come under the surface from the things that have not outperformed. Now, where are we in the process? This is a great chart from Fundstrat that lays out the composite performance in an election year since 1950, which would be the gray line, which shows a lot of sideways chop for the first 3 months of the year, a little pullback in March, and then you grind higher to those high single-digit returns by the end of the year with a little weakness right before the election in the latter part of the year. However, in those years where the stock market is up 10% the year before the election, you get a little bit more outsized performance straight out of the gate and for the whole year. So the composite would imply the S&P actually does push through beyond new highs and brings a number of skeptical people in that missed the 9-week rally, brings them into late January, early February, and then we get that normal weakness in March that you would get any election year followed through. Now, none of these are cast in stone. Anything can happen, but all we do in the business is play probabilities. And in terms of the type of business we invest in, and I say invest in, don't trade in, we have a 12 to 36 month plus time horizon on what we're looking for, because we're looking for outsized gains, and you just generally don't get that inside the 12-month period. And plus, we want to be tax efficient for our clients as well. And then finally, this is from All Star Charts. This is just the 4-year general composite over time. And as you can see, the second year is weak, which we had in 2022. The third year is strong, which we had last year. And then the fourth year is also an up year. You can see here it starts off a little choppy. Again, a little weakness in March and April, followed by single digit to high double digit years. So we're very constructive for January 2024. As I said, I can't tell you what's going to happen in the next 2 days, 2 weeks, or 2 months. It could be sideways chop. We could go a lot higher, draw people in, and then maybe get a little more defensive into March. But on balance, if you just close your eyes and come back at the end of the year, I think we're going to be up in a nice way, and it should be a decent year. This is also confirmed by this data from for the Dow Jones since 1987, from 1897, 1897, over 120 years, showing the average returns per year in a decade. So the second year tends to be the weakest, then the third year starts to rebound like we saw last year. Fourth year is a little sideways chop, finishing up stronger. And then the fifth and sixth year are, on average, the biggest years. So we could be in line for what we talked about, which is after you break out of these, the rallies tend to last for a couple of years on average, unless you get a once in 100-year event, Black Swan. And I think that's kind of where we are. And that coincides well and syncs well with the pattern over the last 120 years. And then you look at earnings. Obviously, earnings have been sideways for the last 3 years. They're going to jump up. We're looking at 12% earnings growth for 2024. And a lot of that reason is managements were preparing for a recession in 2023 that already came in 2022. So everyone's waiting for a recession that already came in the first quarter, 2 quarters of 2022. If you go back and look, we did have a technical recession of 2 consecutive negative quarters of GDP. And for everyone saying, well, look at the yield curve. Every time the yield curve inverts, we get a recession. But if you go back a little bit further, all the way, talk about a mid-cycle, 1995, but the better comp would be 1980 to 1982, when you had an inversion that led to the first correction, just like we had in 2020. And then you had a second inversion. And after that second inversion in 1982, the Fed shifted from an aggressive hiking cycle like we just had to an easing cycle, and it actually set off an 18-year bull market. So while everyone was looking for the second recession in 1982, and some prominent names really got that publicly aggressively wrong, the opposite actually happened, and it actually birthed a record secular bull market for the next 18 years. I don't think we have 18 years because I think we're mid-cycle, as we discussed earlier, but I do think we have very good things ahead for some time. Dry powder and interest expense, you've seen this, money market fund assets. Now, the bears will say that this is just because the banks aren't paying proper interest on deposits, and therefore everything's moving to the money markets, and that's just going to be permanent money because it's just what was deposit money is now money market money. But one of the things I said in the podcast early last year, when everyone was pounding the table, why would you take equity risk when you can get 5% doing nothing? And what I said in my podcast regularly to my viewers was, we look for the max pain trade. So the max pain is the context is, what move in the market would cause the most amount of pain to the most amount of people at any one point in time? And when everyone was crowding into 5%, well, if the market went down, they won. If the market went flat, they won. So the only thing that could cause pain to everyone that was crowding into 5% would be that the stock market does a whole lot better than 5% and they miss it. And that's exactly what happened in 2024 with the S&P up well over 20%. All the people that were in 5% lost 15% that they'll never get back. So where is the max pain right now? What we're seeing is, yes, we're starting to see a little euphoria. So we could have some bumpiness in the first quarter. Maybe we'll push a few more people in, convert all the pessimists in late January and early February before we finally get a nice 5 or 10% pullback in March, April, and then resume the uptrend. But this money, this $6 trillion, as rates come down, and this is no longer 5%, it becomes 4%, et cetera, and the stock market performs, I think you're going to see a lot more of this get forced into the markets over time, and that would be the fodder for 1 to 2 year rally after the breakout, which would be consistent after 2 years of no gains and sideways consolidation. The other aspect that you want to keep in mind is balance sheets, both for the individual debt service as a percentage of income and for corporations, corporate interest expense as a percentage of profits are near all-time lows. You have to go all the way back to World War II to find the interest expense for corporations at a lower rate as a percentage of profits. The final bear argument, money supply contraction. M2 money supply hasn't contracted this much since since the Great Depression. Therefore, we're going to have a Great Depression. That was a common theme last year until the stock market went up 25% and then they all flipped. And some of them still haven't flipped. So what you're seeing here, though, if you put it into context, is we had an aberrational period. So while we've had money supply contraction, it still ran $4 trillion above the normal trend. And this is very, very important to understand, is that it's going to take several years to work off this excess money supply. All the money that was put in the system, monetary policy, now fiscal policy with the IRA, there's going to be a lot of money put into the economy this year, left over from the IRA. So you can see here, just to get back to trend, we're going to have to contract a lot more. And that is still a bullish trend of increased money supply. This kind of shows the different frames from that long-term secular. If we are to follow the bull market from 82 to 2000, you can see how we're tracking here, and it could go straight up. If we're to follow the more subdued version from the 48 to 1968, you can see we still have a lot of runway. My guess is it'll be somewhere in between, but the Slumer model is implying that off the lows, each of the previous secular bulls was 2,300%. And if we got a similar return of 2,000 plus, that would put the S&P 500 at 13,500 to 14,000 by 2034. Look, it's never that easy, but I think in the context of most people being bearish for the last year and a half and keeping a lot of people out of the market, I think it's important to keep in mind that while the 9 weeks rally looks like a lot, it's this tiny little line here, and we're just now breaking out. So let's get to some exciting stocks, turnaround stocks that I like to talk about. As you can see, look at PayPal. The stock is down 80%. Okay, so you would think, oh my goodness, their revenues must be crashing, their cash flow ability to generate cash, maybe they have balance sheet issues that they're going to go bankrupt. I mean, what kind of stock drops 80%? Well, I don't know. Let's take a look. The stock historically traded at a 30 PE multiple. It's now trading at about 12 times forward earnings. And you can see here that the revenues per share since 2015 have gone from $7.56 per share now up to, call it 28. So they've gone up 400%. The cash flow per share has gone from about $1.50 a share to 5. So 200% gains, or 3x. And the earnings per share have gone from about $1 to, call it $4. So 300% or 4x. And yet the price is basically the same. Now, this business is a consistent double-digit compounder of capital. Its return on invested capital is high. So what has caused the stock to fall from $310 down to $60? And that is, there is a fear about declining margins and increased competition. The solution, the new CEO is Alex Chris. He came from Intuit. We want to bet on this new jockey. He just started in late September, early October. He ran the small business division at Intuit, which was 50% of the revenues during 2008 to 2023, when the company actually was a 38 bagger. So he was responsible for 50% of the growth, part through organic, part through accretive acquisitions, which he's going to do with PayPal as well. Stock went from $18 to $7.07. He is committed to turning PayPal back into a growth company. Right now, it's trading like a value company. He wants to reaccelerate growth. And PayPal generated $5.2 billion of free cash flow in the last 12 months. So it's not a solvency issue. It's not a declining in earnings. It's not a declining in anything. It's just a decline in multiple on the fear of margin contraction from the Braintree business. I'm going to talk about that. The Braintree margins are stabilizing. He said in the last call he expects an inflection in Q4, which we're going to hear in coming weeks, which will be a huge boon to the stock. This is the path to 150 in our view. Again, not in 2 days or months, but we take a 1 to 3 year plus view on all of our positions. They have started firing all the unprofitable customers in Latin America. If they have customers that they're not making money, they're just closing their accounts and focused on profitable growth to get the growth multiple back as these margins start to inflect. They've got $428 million accounts, 10% enterprise of the global enterprise business. That's the Braintree white label stuff. It's not the PayPal branded stuff. It's the white label stuff. So it's $5 trillion business abroad. They've got 400 to 500 billion. Think about Uber. They have Ticketmaster, they have Adobe, they have Booking.com, those type of business. And that's where he said the margins are going to inflect. And that's what the analysts have been worried about previously before he came in. So once they see a light at the end of the tunnel, that multiple is going to get re-rated. Their total payment volume was up 15% year on year. Last quarter, revenues were up 8%. And they did $5 billion of buybacks in 2023. That's going to continue. They also have this PayPal USD stablecoin opportunity for the crypto crowd. And buy now, pay later, they are a leader in that group. Venmo is a verb like Kleenex, FedEx, Uber, etc. And the focus on profitable growth, cut expenses, implement efficiencies. Disney is our second turnaround, Tom, pick of the week. History doesn't rhyme, but it does repeat. There are two major oil families in Texas. One is the Bass family, and they put $300 million in cash and in kind for a 25% stake in Disney 1984. It was a very similar situation. The parks were stale, the legacy IP, the classic movies were underutilized. They hit a slump in creativity, and their media business was struggling. Does that sound familiar? Well, what did they do? They appointed Michael Eisner. Okay, so we got Iger back. We're also going to have further succession in the next 2 years. And the turnaround was the big thing. The new technology was the VHS tapes that you put in a VCR. Most of you won't even know what a VCR is, but it was this rectangular black thing with tape. It looked like a cassette tape. You probably won't know what that is either. But you put it in a box and it plays the movie. So they took all this old content library and put it in these black squares, and they made billions on those black things for the next 20 years. The VHS tapes, old content, new technology. That is the theme. And that's exactly what we have now with streaming, which we're going to talk a little bit about here. They hired Jeffrey Katzenberg to resuscitate Disney animation. Out of that, they got The Lion King and Beauty and the Beast. They expanded hotels and theme parks internationally, Hong Kong and Paris, and they 4x profits over the next 10 years. That $300 million became worth as much as $5.8 billion over, by the late 1990s. And now we have a similar situation where the stock has been consolidating for a lot of years. It's down 60% right now off of its recent high. And you have a new activist in Value Act and also in Trian Partners that are going to catalyze these changes. just like the Bass family did in 1984. So they're investing $60 billion in parks because it has the highest return on invested capital over any of their other businesses over the next decade. Their parks and their consumer products has $10 billion of EBIT. We believe that's worth about $80 a share, which is basically where the stock is trading right now. But the implication of that is that all of the other parts of the business, theatrical movies, ESPN, which has the #1 share in sports and growing, Disney Plus, Hulu, TV networks, are worth zero. We think they're worth a lot more than zero, and we think this can work its way back up into the mid to high 100s over the next few years, and maybe to new highs. That's a huge upside. So they're well ahead on the cost cuts. They're actually now cutting $2 billion more than they had originally planned to, and they are focused on quality versus quantity. And finally, my last idea is Alibaba. This is the one that is causing half of the viewers to lean over to find a garbage can and try not to do their business from a sick stomach after hearing this. This has been dead money for over a year and a half. It has gone nowhere. It bottomed in early 2022. We're now in 2024. We're retesting those lows. And but again, we are now, you're able to buy this stock at the same price it was at when it IPO'd in 2014. The difference is, since that time, the revenues have grown by 884% per share. The cash flow per share has grown by 500%. The earnings per share, 500%. So what's the problem? Similar to PayPal, which had historically traded as high as 30 times multiple and now is trading at 12 times forward. Baba's trading at about 7.5 times multiple because of the geopolitical risk. Everyone says Xi is terrible, except for the fact Xi was also in power when the stock was at $310. So bottom line is the patient had a heart attack. You had the shutdown, lockdown that was more severe. You didn't have enough stimulus coming out of it. So it's just taking the patient a little bit longer to get back on his feet. But, it will. And people always ask me, what would cause you to sell? And the answer is if cash flow and earnings power started to decline for a few quarters in a row, and the business was deteriorating, even though the economy grew 5.2% in 2023, which just announced last night, then we would reevaluate. But that's nowhere in sight. If anything, the opposite has been happening. Cash flows are growing, earnings are growing, the business is growing. And then what will be the catalyst for a re-rating is just as their overall economy accelerates. Microsoft had the exact same problem from 2006 to 2013. The stock went sideways for 7 years. You can see from here to here, but revenues doubled. Cash flow was up 200%. Earnings more than doubled. The stock did nothing. And then all of a sudden, they had a succession plan. Satya came in, and the stock over the next 7 years went up 1,500%, 15 bagger. By the way, the revenues, earnings, and cash flow did not grow that much more under Satya Nadella as a percentage basis than it did under Ballmer. But under Ballmer, the stock went nowhere, despite the fact the business was growing. Under Satya, you got a re-rating of the multiple because you had a new catalyst. And we believe that's going to be the case with cash flow growing PayPal, cash flow growing Baba, and Disney as they complete their turnaround. Now, this is the last piece I want to say. Voting machine in the short term versus the weighing machine. Everyone says foreign purchases of China stocks are at an 8-year low. Therefore, this is a bad time to buy, except the last time they were this low was 2015 when the stock was in the 50s after it crashed from 120. There were no sellers left. And what happened over the next few years? It was a six-bagger, up 500%. Similar type thing. Here is the last piece. Number one is the dividend yield is higher than the bond yields. The last 5 times this happened, the indices were up 57% on average with 100% hit rate. And you can see these 2-year consolidations. Back here, revenues were $6 a share. Cash flow was $3 a share. Earnings was $2.60. Then all of those revenues tripled. The stock went from 50 to 200. Cash flow doubled and earnings doubled. And now revenues are up 10x. Cash flow is up 4x and earnings are up 3x. And here we are at the same prices. It's just a question of time. We finished most of the consolidation. We think we're poised to get a monster rebound, and we're going to see a breakout like we've seen the last two times we've had this long a period of consolidation, despite improving fundamentals. So in the short term, avoid the emotions and focus on the fundamentals for the weighing machine, and you'll get the results. My podcast you can find anywhere, Hedge Fund Tips with Tom Hayes. You can find me on Twitter at Hedge Fund Tips, or search YouTube for the video version, Hedge Fund Tips, and you'll see all the channels. There's my contact information. If we have any questions, I'll be happy to take one or two.
Okay, we are a little bit over time, but we did get one question. Will the current massive debt to GDP ratio impact the presidential election cycle positive S&P return pattern?
Perfect question. The last time we had this high debt to GDP was post-World War II at over 120% in 1948. By 1958, that ratio had come down to 63%. How did they do it? They inflated it away. So they ran inflation above trend between 3 to 4% range. Above trend should be 2%. And they were able to inflate it away. And that started and coincided with that 20-year bull market we covered from 1948 to 1968. So yes, we have a lot of debt, but they'll let inflation run a little hotter, 3-4%. We'll inflate that away. We'll get growth. The consumption and the production from the millennials will offset that, and we should be in good stead. That's not to say they don't have to fix things in Washington, but I think we're going to follow a familiar playbook from the 50s and early 60s.
And we're back. So if you couldn't see all the slides perfectly, there were a lot of very important slides on the deck. But for my money, this is the most important one. This is the Alibaba slide, the voting machine versus weighing machine. And we covered this last week, where foreign purchases of China stocks dropped to an 8-year low in 2023. What they don't say is the last time that foreign buying was this low was the bottom in 2015, before you had a 6-bagger return over the next 4 years, 500%. And what's more important, we covered the dividend yield last week. Every instance that you've had the dividend yield higher than the bond yields, you've had an average 57% rally over the next 12 months in the indices, which means individual names are up a lot more. And then this is the most important chart in my view, the weighing machine. So we talked about these couple-year consolidation patterns, and we're just at the end of a 2-year consolidation pattern here, where the market basically, where the stock basically goes sideways, even though fundamentals are improving, and then the price dramatically accelerates to catch up to the fundamentals. So in 2015 and 16, you had revenue per share of $6.34. You had cash flow per share of $2.93, and you had earnings per share of $2.60. And the stock was trading between, call it, it got down to 56, but basically between 60 and 100, in this range that we've been in for the last 2 years, between 60 and 100. Then it took off, and it was basically went from 50 to 200, so 300%, a 4-bagger. And by the time it was up at that level, the revenues per share had gone from $6.34 to $21 per share. The cash flow had gone from $2.93 to $6.66, so more than doubled the cash flow per share. And the stock price, what do you know, doubled. Sooner or later, it catches up. And earnings per share, $2.60 to $5.67. So the earnings doubled. All of those things doubled, except for the revenues tripled, and the stock doubled from its high point. From its low point, it was up 4x, 300%, and so on. And then it took off again. Then we had the crackdown, we had the pandemic, we had all the nonsense, and the stock crashed 80% or whatever it was. 80%. And it's basically been dead money for 2 years, doing nothing but driving us crazy. But the good news is the fundamentals are dramatically improving. So when the stock was in this 160 to 200 range before taking off to 300, they were doing $21 a share of revenues, $6.66 of free cash flow, $5.67 of earnings per share. Now it's doing $57 per share of revenue. So it's more than doubled, 2.5x, or 150% more revenues per share. The cash flow has doubled, and the earnings have just barely doubled, and yet the stock is down 80%. So you basically have, from the last time it traded down at these levels, revenues up 9x now, more than that, 9 times 6, 9x, cash flow up about 4x, and earnings up about 3x. So for those of you who, it's funny, people always ask, well, what would make you sell? Well, what would make me sell is if I saw a sustained period of sequential quarterly declines in free cash flow that looked like a permanent impairment. Revenues were going negative, cash flow was going negative. There was no good explanation for why, other than they were losing share in every single business and declining. And even then, based on where it is today, it could probably lose 25% of revenues and 50% of cash flow and still be cheap. But leaving that aside, the opposite has actually been happening, which is why we've stayed with the stock. The only thing that's changed to our thesis is we own a, to put it mildly, shit ton more in the 70s, below 100 than we do above 100, and a ton now in the 70s and 80s. So we're excited about this moving forward. What will be the catalyst? Someone asked this silly question, when will it moon? I don't know when it will moon, but the thing is, there were no explicit catalysts that caused it, other than in the short term, it's a voting machine based on emotion. In the long term, the market's a weighing machine based on fundamentals. Maybe it will be new stimulus. Maybe it will be the old stimulus finally kicking in on a lagged basis that they've been doing over the last 12 months. Maybe it will be the Fed actually cutting and the dollar declining. It could be a million things. It doesn't matter to me, because the key is the framework. I didn't know that Intel was going to go up and double overnight. I didn't know that Vornado, we were in Vornado for 36 months. It just doubled in 6 months. We have no control over when. We just know if we buy it right, we buy quality value, the highest quality in a particular area at the period of max dislocation, good things happen. And we don't know when they're going to happen. We don't know if Disney's going to double in the next 12 months or in the next 48 months, but there's a good chance Disney's going to double from these levels. And we went into that in the Money Show presentation. But when you own 8 to 12 companies per portfolio, some go very quickly in 6 months and 12 months and 18 months, and others take 36 or 48. But over time, you get the excess IRR that you need, net of fees for your clients, and that's what we're looking for here. And this is just one piece of the puzzle. I thought this was comical this week that the Chinese stocks sold off on perceived GDP print of 5.2% for 2023. And I just kind of drew up all the other countries in the world that everyone's all bulled up on. US had a great year at 2.4, and everyone's bulled up and it's making new highs. China had a year of 5.2, which is more than double the growth, and people can't sell it in the hole fast enough. So that's just nature. But this is how you make your money: is buying when it's unpopular and out of favor. Whether it's anyway. So that's the story. I actually, we are generalists. We specialize in dislocation, whether it's sector, company, or market, or country dislocation. I want you to hear from a specialist, Brendan Ahern, and his colleague from China. They did an amazing podcast today. Unfortunately, I was only able to catch 40 minutes of it, but I think it's so intensely valuable. He runs the multi-billion-dollar ETF called KWEB, KWEB, which is China Internet. If you don't have the level of conviction that I have, that BABA is the best risk-reward way to express a view on emerging markets in China, and you just want to have a basket, you should look into KWEB. Brendan's a good guy, and you'll get exposure to the top 10 Chinese companies or whatever. But I want you to listen in here, because a lot of the catalysts, and watch what he says about Alibaba's bond performance versus stock performance. It's going to blow your mind. And hearing the same theme with greater specificity from a specialist will help give you the same level of outlook and confidence or conviction, or at least framework that I have that's enabled me to hold tight and use these opportunities to take advantage over the past year and a half while the stock's basically done nothing as one piece of the portfolio. So listening to Brendan and his colleague.
But this underperformance is not driven not unique to China. MSCI emerging markets is not even up 200%. And in fact, all country world ex-US, so all stocks minus US stocks, is not even up 1/3 of US stocks. And it's interesting that we see an element of investor trepidation around China, and you've actually seen the growth of EM ex-China strategies, but in fact, MSCI emerging markets Latin America has performed almost as poorly as not just China, but emerging markets and non-US stocks. And yet you don't hear about EMX Latin America strategies, do you? And I think the culmination of 14 years, 56 quarters of client calls, board meetings, trustee meetings is investors are grossly underweight non-US EM and China. And the most crowded trade globally is US stocks. And again, on craneshares.com, we articulate this thesis in our 2024 outlook. And the last gasp of this US equity outperformance has been under the narrative of AI investing. We see this renewed Magnificent Seven US tech equity outperformance at the expense of basically all other stocks globally. And we just don't see how this is sustainable, particularly looking back over the last 14 years. And a contributor to this outperformance on the next slide is that in order to keep up, active managers, global equities have moved so many of their assets into these top 7 stocks that, utilizing our friend Stephen Holden of Copley Fund Research, he's proven this by looking at the underlying positions of these actively managed funds. In order to survive, these managers are buying these small subset of securities across the thousands of securities across the globe. They're all piled in overweight in this small subset of securities. And from our travels of engaging with many investors across the globe that utilize our exchange traded funds, we just cannot remarkably find how many of them are overweight US equities. But some element of that is out of self-preservation, that there's only one asset class, one subset of an asset class that's working, and that's this small number of US tech plays. And I think on the next slide, you know, if we step back, that unfortunately as we age, we can say that reminds me of something. And I can't help not remember in 1999, we had a very, very similar situation where a very small subset of, again, US tech stocks were the only thing that was working globally. And investors all piled into these names at what turned out to actually be at the exact worst time. And in fact, if you look at what happened following that small subset of securities, it turned out it was that concentration that of this small number of stocks representing such a disproportionate percentage turned out to be the proverbial canary in the coal mine. And I think we've seen this. You know, the financial sector became 25% of the S&P 500 right before the financial crisis. And we're seeing that situation again play out. But we have to understand that why is all of this money coming out of non-US, out of EM, out of China, into this small subset of US? It's an AI craze, or is it just the survivorship, the necessity to own the only thing that's working? And another factor at play on the next slide has been the shift from active to passive. that active managers in the EM space, but certainly for global equities, are losing their assets to passive index funds and exchange traded funds. And data from Morningstar shows that it's kind of remarkable. 20 years ago, 90% of EM assets were actively managed, but that's dropped to 60%. Now, in fact, active fund managers are managing the exact same amount of money as they were 10 years ago. Now, why is that important? It means there's less managers around that exist to buy the dip. And in fact, one of the things we've seen is that many of these active EM managers are actually buying US stocks. One of the developing market funds here in the US, their largest holding is Microsoft. Does that make any sense? But if you think about this long period of non-US equity outperformance, the only way they can survive is buying the only thing that's working is US stocks. And this is happening from professional managers all over the world. They're all going into the most crowded trade. And I think, again, going back to having seen this before, on the next slide, if we think about some of the headlines we're seeing today on investing in China, it reminds me of what I was reading back in March of 2009. When the US market hit rock bottom, US and many global investors gave up on US stocks. And that turned out to be the best time to buy. And the similarity of these headlines when you talk about China and market sentiment versus back in when it came to US stocks, and I understand a little bit of why the sentiment exists on the next slide, that back in 2009, you had a 10-year period where US stocks had a negative return. I mean, if you invested in US stocks from 1999 to 2009, it's not only that you lost money for those 10 years, is you suffered 250% drawdowns. I mean, who can take that? And what do? You give up. You simply give up. You capitulate. And I think that same scenario can be applied today, that we have 14 years US stocks have outperformed non-US stocks, including Chinese stocks. And the end reality was this capitulation built the foundation for the US bull market, equity bull market. And I think the capitulation, when you talk about China, has actually built the foundation for the next 10 years. And that's true for China, emerging markets, non-US equities. And I think the extreme situation of what's exacerbated this capitulation has been what's been taking place in Hong Kong more recently. That on the next slide, there are it's called callable bull bear contracts, CBBCs. And these are contracts issued, investors buy these contracts that give them exposure to Hong Kong and Chinese indices in Asia, particularly Hong Kong. And unlike European or US structured products, these contracts have very explicit liquidation levels, knockout levels, if an index or a stock in Hong Kong or in China hits those levels. In China, they call these contracts snowballs. Mm-hmm. And what you can see is, this is using the Hang Seng index as an example, is that over the last month, as the markets come down, and again, you have this absence of buyers, that investors, they only own one thing. You have these US tech stocks. So this absence of buyers has exacerbated a situation that when these contracts hit big round numbers in the Hang Seng Index, like 17,000. The issuers have to liquidate the underlying. So in this case, they're liquidating Hang Seng Index futures. And there's the lack of buyers because of this infatuation with US tech means that the market takes an elevator down. And then what you can see, what happened when the Hang Seng hit 1650, 16,000, right? Elevator down. There's no buyers because they're all in US stocks. Now some of this is a trepidation of investors not wanting to try to catch a falling knife. They're worried about some of the China headlines, but explains this dramatic underperformance. And people say, it's because China's GDP numbers. I mean, the China numbers beat the expectations. It's just investors have been sidelined. And that's led to this dramatic downdraft. Now, I think one of the things we want to talk about is why investors should want to come back. What are the catalysts for investors to say, hey, enough is enough. We got to get back in. And I think, today it's noted that NASDAQ's price to book is higher than Hong Kong's PE ratio. I mean, does that make any sense? The only explanation is this most crowded trade US tech stocks globally. And we think that there's some reasons that investors should be coming back in, taking a look at what's happening, particularly in non-US EM, but particularly in China. I know on the next slide, Jalin, we're noticing one of these things that investors should be getting on their radar.
I agree, Brendan. I think with everything you said, trying to explain what was causing the kind of like corrections in the recent days. One of them was now the expectation to say US dollar, the rates may stay high for longer. And we see in one of your CLN, I think it was yesterday, you mentioned US 10-year Treasury now has surged past the 4% level again. I haven't checked today, so I apologize if it's back down, but it was 4% yesterday when we're looking at it. So that really also weighted heavily on, per se, risky assets, and obviously created a bit of a discussions to say where and how we're going to make the dollar, strengthen. We go back to dollar assets, put on a lot of pressure on obviously risk assets, causing some, corrections. But one of the correlation we have been studying and noticed is the correlation between KWEB and CNY, which is as a very clear indication of the renminbi, picking up. And on this chart, you can clearly see that we go back as far as when the fund was since launch. So this is over 10 years of data. Obviously, we have studied and learned that now by looking at it, KWEB is highly correlated, or the relationship of the correlation are positively developed since 2017. Obviously, at this juncture of time that we have studied the trends, we'd like to think that, renminbi's, given where renminbi is at today, that given the activity picking up in China, given all these policies that is set, given all this liquidity is in the systems, that we do expect manufacturing and subsequently all the other activities to pick up, hence supporting our view on the currency would actually go positive from here. Hopefully that is a study, a catalyst we could look to say, if that's the case, KWEB as a result should actually have a one as positive catalyst to pick up from here, Brendan.
Yeah, I think, Jalin, it's such a great point that, the last decade's been marked by, the U.S. Federal Reserve cutting interest rates. And, certainly, we're in a very different environment, and the dollar, the U.S. dollar index since the 2011 low is up 40%. If U.S. stocks over the last decade kind of robbed the bank, the U.S. dollar is driving the getaway car, right? The U.S. dollars aided and abetted this outperformance of U.S. stocks, and it'll be very interesting, right, to see what Fed, we know Fed policy is going to evolve this year. There's a big debate on interest rate, but I think we start seeing those interest rate cuts. There's a strong argument potentially for the dollar to weaken a little bit, and that might help in this movement back to non-U.S. China, and particularly China across EM. Certainly on the next slide, one of the other indicators we've noticed is that the asset classes always compete with one another. Where am I going to get my best return? And one of the way to think about that is putting yourself in the shoes of an investor. So in the case of U.S. investors, we know you can get a lot of money just sitting in a money market fund, or up until last year, I'd never bought a certificate deposit, and now I'm like an expert because I'm getting like 5.5%, and that money would have gone into stocks. And so if you think about what is a money market, how does a money market compete with stocks in the U.S.? Well, we could look at the dividend yield. This is very simplistic, and you'd say U.S. stocks look very unattractive relative to what cash gives you. In the case of China, it's the exact opposite. That if we look at the dividend yields of mainland Chinese stocks versus their 10-year treasury, stocks have never looked more attractive. In fact, stocks in China yield almost as much as the 10-year treasury. And that's a situation that's never occurred in China. And in this business, you never say never, but we're saying it today that Chinese stocks have never been cheap, as this inexpensive relative to bonds, based on this very simplistic measure. And I think if you continue to see easing, incremental policy easing in China, it's only going to exacerbate that trend. And I know, Xiaolin, we know some of the things that weighed on investing in China, things like the zero COVID. But I know, we want to talk a little bit like some of the fundamentals of these underlying companies. How are they looking to them?
Brendan, it's fairly to say when we, trying to get the real insights from it. And at the beginning, we did mention, we think the current performance is completely disconnected with fundamentals. We have evidence to say so. It's not just looking at it. If you count it, it's all the policies announced last year. Monetary, physical, corporate policies is all on pro-growth, where the market is taking every opportunity to say, where can I find a bit of a slightly negative angle? Let's sell. The reason we say that is if you look at this page, is this purple bar is showing the top 10 holdings in the KVAP fund. What are the quarter over quarter of earnings throughout its history? This blue line shows KVAP's return. And if you go back to history from 2019 or even earlier days, clearly the fund performance in reactions or in reflections of how the underlying company has been performing, which is very fair. How you performed, we return stock performing in conjunction, in line with that. Obviously, since pandemic, the market start to behave very differently. You start to taking a lot of macro headline news to react on performance. And since then, you see, obviously, because of regulations impacted the sector, because of the COVID impacted the industry and economy as a whole, we did see a bit of a correction in earnings, but then the corporates really very much back on their own foot to continue to return quite interesting, quite attractively in terms of revenues quarter over quarter, where the fund's performance is completely on a different direction now. If you see the blue line is continue to going down, but obviously we have seen picking up in performance marginally in reflecting the solid fundamentals quarter over quarter the fund has been generating. All that being said, we do think that at a certain period of time, macro factor could drive underperformance, but cannot be sustainable or cannot be long-term of drivers of stocks performance. In this instance, we do think that the fundamentals will drive the stocks performance this year, given all the set scene of the macro level are very pro-growth. That will give investors the confidence that it is the time to look at the fundamentals. It is time to reflect the strong growth that each company has been producing, and that would reflect the gap between the current performance and the quarter-over-quarter earning accumulated by all these companies. The big gap, we do believe that gap will have to close.
Yeah, it's just remarkable that you'd think these companies have been put out of business, and it's the furthest thing from the truth. But I think going back to this thesis, this U.S. equity outperformance over 14 years, just pulling all of this money out of non-U.S., out of EM and China, going into U.S. mega cap tech, has created a situation that's reached a level of ridiculousness. Regardless of what AI does or doesn't change our world, the simple reality is that with the market cap of Amazon, you can buy all 31 companies we hold in KWeb and have almost 400 billion in cash left over. I mean, if you think about that, saying Amazon is more important, has the same purchasing power of 1.4 billion people. I mean, just yesterday, retail sales, it was reported the online retail sales is growing pretty dramatically. I mean, you're telling me one company is more important, but to explain, all of this money coming out of non-US stocks, it's creating this level of ridiculousness. And remember, if you aggregate the 31 companies in KWeb and compare that to Amazon's revenue, Amazon's cash flow, Amazon's net income, Amazon earning per share, Amazon is lower on all of them. And it just shows this forced capitulation, we feel has really created a compelling buying opportunity in China today. And it's self-serving and highly biased to say KWeb, but we're going to say it, right? And one of the ways to prove this thesis is there is an investor who actually breaks out, a Hewlett-Packard 12C calculator, actually does the math, and that's bond investors. So what has Alibaba's bonds, which are denominated in US dollars? So if we look at this, you have to recognize that just like any bond in the US, as the US raises interest rates, bonds have duration, they go down, right? So Alibaba's bonds have come down, no different than other US corporate bonds or US bonds in general. But how is it possible that Alibaba's bonds have outperformed its stock? Why are equity investors, because they're driven by sentiment, bond investors say, is a company generating enough cash flow to pay back the coupon payments and principal of its bonds? And just to be aware, Alibaba has very, very little debt, very little. And this is true for Tencent. It's true for Meituan. If you look at their US dollar bonds, same thing is true. The bonds are outperforming. It shows, it is evidence of this capitulation. And it's why we think investors should be coming in. Now I know one of the things, Jelen, that's really weighed on investors has been the US-China geopolitical. I think it's worth highlighting some of the things, we've noticed as a team on an improving situation there.
I'd agree. I think, from last year, we have seen many interactions, let's put it that way, to start at high level of senior leadership interactions. And then that's really let Xi and Biden meet again later in the year. I think a lot of efforts been put in either by Janet Yellen, all these, very much key figures in deciding in the US relationship with China and vice versa. China also send, represents to Davos, so everywhere to make sure they connect, they talk, and they make sure the environments, or at least the overall sentiments towards each other is very pro-growth, very pro-constructive. So they finally met each other later the year, Xi and Biden in November last year to meet in San Francisco. One way or the other, we see positive progress. Let's put it that way. We obviously seeing number one, number two economy in the whole world. We literally anyone just want them to be talking to each other, to have a conversation, to have a discussion, to have a dialogue, and literally to be able to be moving on, even disagreements in a constructive way. They did that. I think that box is checked. And the fact that President Xi Jinping flied thousands of miles away from Beijing and willing to make that trip to United States, that shows a lot of one, U.S. is an important partner to China. Second, from China's side, they clearly wanted to be working with United States more constructively. They show their commitment. And then third, I think he also hosted a dinner in San Francisco, which I think John had the pleasure attended the dinner, and he listened to Xi Jinping's speech by himself. Okay, no translation, no whatsoever of second, third take of how they take on Xi's speech. And John was there among all the CEOs who listened to his speech. It was very much, we open the door, we welcome international investment to our country. Can we believe that? I would say yes. He has no reasons and rationales to fly thousands of miles away to the United States to please USA CEOs, okay, unless he really mean it. And he did it when he come back. Remember, I think he approved MasterCard to do business in China. Credit cards business is very strictly only dominated by the 4 big banks in China. Opening up a credit card business for MasterCard is actually a very big step forward. In terms of financial reform, welcoming or set an example of they want to welcome foreign investments into China. Many to come. I think there's other announcements came after the visit, so on and so forth. So to me, this is a very interesting year, biggest election year in the history, probably UK, US, and many are under election. So we got to watch and see. But then the intention from China's side couldn't be more clear. They want to work together. So I would say that. And then on top of that, if you look at the economic data, obviously it's very hard when you have a bit of a top level that is talking very tough with each other. But at the end of the day, if you look through the noises on the next page, we literally had this trade data. Our analysts put this together. I think it's very amazing to see, despite all the high level discussions and talks happening all there, China is still remain the largest and the number one trading partner with the United States. With proof, you can see that when China welcoming U.S. business into China, when they continue to make sure approving new business that is used to be quite restricted in China on the restricted list, now it's become more open. We expect this trend actually continue to happen, continue to be the way it is. So business is doing business continuously. The business in China or in U.S. continue to say we got to put our shareholders' interests first, to make sure we continue to trade with the largest trading partner that we have and continue to generate revenues that we can for our shareholders. This is very encouraging to see, even despite all the challenges we have seen and witnessed in 2022. I believe is the same trends in 2023 is the same trend. So it's very encouraging to see that. The other topic, I think President Xi went to San Francisco to see Mr. Biden was also for the reasons of Taiwan. Obviously, the election happened just about I think it was 16th of January when the results comes out. It was one of the weekend that the results comes out. The current party win the election. Obviously, they were talking very soft during the campaign time. Now they win the election. Is now they say they will put the people's interest first. I hope both sides, the leader keep their promises. If they put that people's interest first, that would have to mean they have to create a very friendly environment on both sides to allow business to continue to work with each other. At the peak of when China entered WTO, we almost had every Taiwan business that had a revenue or had interaction connection that is in mainland China. So you see the peak was to go back to as close economically tied as that. Brandon, you were in Asia. Was there anything you want to add on China and Taiwan?
Well, I think one, a lot of investors say we're worried. I think it's one of the things we write about in our 2024 outlook is again available on cranechairs.com. Is our brains look to find easy solutions to sometimes complex problems, and I find this topic is a complex one. Taiwan was part of China until the Japanese invaded in 1900, following the Opium Wars, in the events that led to World War II. But you never read about that situation. And I think, ultimately the movement of the Biden administration to stabilize the relationship is because, the world can't afford, the U.S. and China. In fact, both sides have so much, we're interdependent upon one another, and that negates, I think, this easy, simplistic narrative of China rolling in. And that's why we love showing people that part of Taiwan sits just 3 miles off the coast of China. And, again, we're very dismissive that, the world, China, the US, there's so much to lose. There's no upside on this issue. And yet it's such an easy to say Ukraine, Russia, China, Taiwan. And I think you have to realize, you have to do some of the math that the effects is just too great for the two largest superpowers not to get along with one another, especially considering how intertwined our economies, our stocks are. I mean, people say, I'm worried about Taiwan, I'm gonna get out of my China stocks. I'm like, let me help you get out. Get rid of your Apple, your Tesla, your Exxon Mobil, your Starbucks, your Nike, your Boeings. U.S. companies are doing great business in China. I think that's part of the Biden administration looking to stabilize the relationship. At the same time, Jelen, I know things are, things looking forward for China's economy. It's kind of remarkable to think that, China's doing twice the GDP of the United States, and yet all the headlines I see are, how bad China's doing. Like, it's doing twice as good as the U.S., and yet you don't read any headlines, right?
I agree. I think, I think you and I often get into the situation. I remember when Alibaba released their earnings last quarter, domestically, obviously, they matured, so single digits return, which meet expectation. Internationally, 53% year-over-year quarter, revenue growth. I was pretty gung-ho about it, and market pick, Jack Ma, the guy who founded it, but has disconnected from daily management for 4 or 5 years by now. That he wants to do some investment from his own family offices. He wants to sell some stocks, and the market corrects it. So I think sometimes we have high expectations, but we also get to be realistic that some data is released in China actually shows the results that the whole economy is recovering, is doing well, is on its own trajectory. And what is worth noting, like you were saying, the GDP numbers in China on this page shows that estimations is they're going to deliver 5% year-over-year from here, which they did this year for 5.2%. If you look at the next page, what we put together is just to remind the people that this is really the first year for the country to just get out of the restricted pandemic. It's the first year they return to focus on growing its economy. It's probably take them about a quarter to realize that, we have to provide sufficient liquidity into the systems. That's why from March last year until the year end, you have seen nonstop, continuously support by the policymaker in China. I literally lost count how many times PBOC has cut the rates to make sure liquidity is sufficient for the corporates to borrow, the credit is available, the rates on, mortgages, first down payment, all of that get reduced to help the household in terms of they have more money to spend. If their mortgage go down, if you have more income to spend, so on and so forth. From all these 9 months, you have nothing, but every policy meeting comes out with one key message: it's pro-growth. If you ask me last year, the results from all the meetings in terms of monetary, physical, corporate policy making is all pro-growth. I think this foundations or the fundamental, the solid fundamentals has been laid out such strong way for the economy, for the corporate to be able to take up from here, to take the liquidity to rebound from here. Obviously, that's last year, but I like to draw people's attention to say, you know what, overall, China's focus, if you look at the next page, this is where China is focusing on growing. Obviously, we want to know, like a lot of clients ask us, where do I look at the growth? Where do I know where China is focusing on its own growth? Is finding a job or is creating a job to feed the people? They want the stability of the social stability to make sure that people has a job, has a better future to look up to, have a very wealthy future to look up to be able to help their own family, their own standards and own status, and also at the long term, China be able to make impact on international status. And we didn't touch base them on today. We didn't have all the time we needed or we wanted. Is on the green transaction side. China invests 500 billions every single year to deal with its climate issues. That's why they are the largest solar panel producer. Nothing but that. They focus on the investment. They focus on their own developments. They are the #1 waste process technology in the world. And we're like, waste process, yes, they're #1 in those green transition technologies. To make sure they are the leaders in those space, we should work with them. We should take advantage of where the investment opportunity is. Let's really take advantage of those that is present in our solutions and portfolios if possible. What we also did is obviously, Brendan, you and I holistically get asked often on this is, what are the catalysts? What do we see, has happened last year? Where can we look forward to? I'd love you to jump in on this as well. But my most proud on this page is bottom right-hand corner. This is a classic example. People say, people is not spending, the consumer is pulling back, is sit back, they're not spending. I didn't see them on the street, they didn't come out to spend massively. Of course, they got to look what is suit them to their lifestyle, their style of spending per se, their style of per se holidays or treatments for themselves to reward them to work hard for the whole year. This is in the city called Harbin. It's literally my hometown. Harbin had a very famous international ice sculptor for 24 years. And this year they built probably about the largest possible ice sculpture this year. And this year, Harbin suddenly become the place to go. I'm very proud for the city's achievements. Literally in just 3 days, national holiday of 1st January in China, just in 3 days time, the city welcomed 3 million people in 3 days and generated 6 billion revenue just in that 3 days of time. Now people is loving the destination, love the place to be, to travel as a holiday destination. Now the city expects they will welcome 300 million people domestically in China to the place, and then they will expect billions, if not trillions of revenue as such. So it's people spending, of course they're spending. This has become very selective where to spend, how to spend. If people are not spending, I totally disagree. Look at the numbers and revenues. Obviously, when you look, go ahead, Brendan.
I was just saying today, Richemont, the Swiss luxury watchmaker, reported that their Q4 China revenue was up 25% year over year. Some of the data on bookings for Chinese New Year coming up in a few weeks looks really, really strong. It's one of the things that, when I was in both Hong Kong and Shenzhen last month, restaurants were crowded and malls were crowded. And when I went to Shenzhen, it was, there were headlines, new COVID crisis in China. And I got to Shenzhen, they were running the marathon that day. I mean, it just, disparity between the call them the nadering nabobs and negativity of Western media versus the reality of what's taking place, what some of the data is telling us. It's just, yeah, it's very
I think,
interesting.
when we touch base on this, we see actively stock buying back, like Alibaba. I can't remember such a growthier company that's now announcing issuing dividends. We look at their current ratio, cash ratio, absolutely most liquid. They are very low leverage. They have pile of cash. Now they have decided to buy stock back, and they also announced first, I think in 20 years, if I get the time right, of issuing dividends to their companies, and this is all showing that now they say, you know what, this is absolutely the cushion. If not, we're buying our own company back. And obviously, from the government perspective, we see nothing but very pro-growth and supportive policies. I know now, we have couple of rounds of trillions of renminbi injections by the government. First, they announced 1 trillion bond issuance to help infrastructure, green infrastructure. Then the PBOC announced another 1 trillion to give to the property sector. And then very recently, this year, into this new year, we got another new 1 trillion debt issuance that will happen this year to also help the needed industry. I think the liquidity is very rich, is sufficient in the systems. The policy is in place. I do think, if anything, you call a near term would be, the MPC happening in March, Brendan. I'd say we would have some more concrete policies announced that will touch base on sectors such as how they're going to boost the consumption again, or even more stronger, how they will allow all these splits of individually going to IPO to continue to happen, how they're going to reform their financial markets. I think all of that would be fundamentally in any market, that would be a huge positive. I hope that investors are fairly treating China as a capital market with all these positive news together as a key catalyst to consider in 2024.
Yeah, I couldn't agree more. I mean, Meituan did their first stock buyback program since going public in 2018, just last week. Today was the 7th day of buying. Tencent buys back stock every single day. I mean, it's something that, we think it's very heartening that the companies themselves believe their stock is so inexpensive. And we just, again, it goes back to, it's not about the fundamentals. It's just everyone overweight these same U.S. tech names. And, I think that's really our core view, is that, we see such an opportunity today. And both on the next slide, we should kind of show some of in thinking about, one of the ways we think about China is offshore China, Hong Kong, the US ADRs are predominantly how foreign investors think about China, whereas the onshore Shanghai, Shenzhen market is more indicative of what do Chinese investors think about China. And I think those two markets can really move quite differently, very low correlation between the two. And we think there's a strong rationale for, both of these markets to come back in 2024.
And we're back. And by the way, you can go get the entire presentation. Just go to CraneShares website, or look up Ahern_Brendan at Twitter, and you can click on this and see the whole thing. I think we only missed about the first 10 minutes, but now it's available as a full recording. This Tuesday, Bank of America published its monthly fund manager survey. I posted a summary here. There were 3 key takeaways. Number 1, being short and pessimistic China has become very crowded. It's the number 2 most crowded trade, short Chinese equities, behind long the Magnificent Seven. You can see when it gets down to these levels here, good things can happen, like we saw in October of 2022 before the dollar rolled over and the Xi did an about face on the COVID lockdowns, and it took off, doubling in 2 months. And then when it didn't, the recovery didn't happen overnight, everyone got pessimistic and it sold off. But we're back at those levels, which is pretty exciting. Sentiment still pessimistic and skeptical, not euphoric. Look at the institutional managers. The percent that see a stronger global economy in the next 12 months is down at 2009 levels and COVID levels right before you had massive takeoffs. Also, their view on corporate profit growth just coming off the mat, still in negative territory. Furthermore, previous instances of lower short rates at this level of extreme proved to be correct. So when everyone believed that short rates were going to come down, they actually did, both in COVID and the great financial crisis. So that's going to be a theme in 2024. The city never sleeps, except for the past 15 years, is the giant awakening from its slumber. If you remember from September 1st, I was on Fox Business with Charles Payne. You can click here to watch the video where we talked about Citi. It was trading around $41.50. That was after we talked about it on the podcast. And now it's up to 53, or got up to 54. It's pulled back a little bit. And so it's just starting to take off here, but barely getting started. We think this thing can work higher into the 70s. And then we'll see how the earnings power starts to look with tangible book and regular book closer to 100. If the restructuring goes according to plan, we'd be willing to hold this thing long term and actually have a massive recovery. But if not, we're willing to take it, get out of it, or just a little bit below book and get a quick double, which would be perfectly fine. We'll see how they execute. But as you can see, they've consistently compounded with all the debacles and all the BS. The intrinsic value per share continues to go up. The share count continues to come down. They've almost halved the share count in the last 10 years. Revenues continue to climb. Return on shareholder equity is anemic, but that's in line with these larger banks. And what they've done is they've simplified the business. They're firing 20,000 people. They're simplifying the reporting structure. Their banking business is fantastic. Their investment banking is coming back. Their fixed income was crap last quarter. But I think they're in a good position, if for nothing else, to ride the M&A and IPO and fixed income resurgence that should be the theme for 2024. And this is the cheapest way to play it. So we like that. And you can go through the investor presentation, all of the key points that we laid off here on your own, because otherwise we're going to be here for 4 hours. But Q1 will result over $1 billion run rate saves from the elimination of approximately 5,000 roles, mainly managers. They got another 15,000 that are coming out. Just want to cover it. There's so much in here, so you should read it. If you're an owner, read it and think like an owner. Want to quickly get to this PayPal update, which is really exciting. Alex Chris's first interview. I talked a lot about it on the Money Show presentation, but take a listen. He said he's going to lay out some things on January 25th. They say, quote, 20 years ago, PayPal revolutionized commerce. We're going to do it again. Tune into the must-watch January 25th, 9:30 a.m. Pacific time presentation with CEO Alex Chris. And what he said on this interview with David Faber is, quote, "We will shock the world on January 25th. That is a tall statement. Listen to this short interview.
Joining me now in his first interview since stepping into the role as the president and CEO of PayPal is Alex Chris. It's nice to have you here. Thank you.
Thank you, David. Good to be here.
It's good to have you. The analysts don't seem to love the stock right now. It's just the last couple of weeks. I've taken a look at a few reports. Mizuho yesterday, PayPal faces competitive pressure from A to Z, downgrade. Oppenheimer, PayPal, or persistent profitability pressure has them downgrading it. Morgan Stanley, slower than expected progress on strategic imperatives. BTIG, too much uncertainty puts us on the sidelines. I mention those because I'm curious to get your response. So what do you say to these analysts to get them to change their mind, or how do you?
Well, look, we're an important company. We've got a quarter of the world's e-commerce running through PayPal. So that's why we've got 45 analysts following us. And, look, to be honest, there hasn't been a lot to celebrate over the last few years. I think innovation's been slow. The company's been growing, but hasn't been putting out real customer-backed innovation. And that's why I'm here. That's why I'm so excited about it going forward. So look, I love being an underdog. I will take all of that feedback and we'll shock the world.
Yeah, you think you're going to shock the world. How are you going to do that?
We've got an Innovation Day coming out on the 25th, where from the first week that I got there, this was not about trying to figure out what to go do. It is very clear what we need to do. 24 will be a transition year for us, but it'll be all about execution, and it starts with innovation. So on the 25th, we're going to come out. We have very clear customer-backed innovation that we will be rolling out for consumers, for our merchants, for Venmo, and I think it'll be a good start to this year.
Anything you can tell us at this point? Obviously, I don't want you to ruin the rollout, so to speak, but when you say you sort of have a very clear idea of what you have to do, and then you say innovation, any specifics you can provide?
Well, look, PayPal hasn't delivered the value proposition to its consumers or its merchants over the last few years that I think we're capable of. We have more data. We see exactly what people are purchasing around the world. So we need to make a better value proposition for consumers, put more money in their pockets. For our merchants, we have the ability to leverage AI to deliver an incredible improvement in their conversion rates. And then we have to let our small businesses and our consumers connect, leveraging AI-driven personalization.
And you believe that, for example, using the data more effectively for particularly the merchant side can bring, higher profit margins? I mean, how does this translate?
Well, look, we have over 35 million merchants that are using PayPal. When we improve their conversion rate, it improves their business, it improves our bottom line. We're kicking things off on the 25th.
I mean, you do have an awful lot of data. You ever consider just selling it or working with others as well to sort of pool that data in some effective way?
The data is our customers' data. It's our consumers' data and our small businesses' data. What we need to do is leverage AI to make it better for them to be able to grow their businesses. Small businesses are under a ton of pressure right now. It is hard to be a small business in good times. It's not good times right now. We can give them an advantage. Advertising costs have gone up 2x over the last few years. We need to be able to give them the opportunity to leverage the data that they have and improve their business.
Right. All right. When you speak to investors now, and it also is encapsulated to a certain extent in some of these analyst reports as well, competition comes to mind. Your lack of significant profit margin expansion and/or actually lack of profit margin. Apple Pay, buy now, pay later. Do you have an answer to these? You talk about what is a still relatively dominant position, but at the same time, it seems as though you've taken on a lot of business that doesn't really have a margin associated with it.
Yeah, I think we have done too many acquisitions over the last few years, and we've been defocused. It was one of the things I noticed when I came in 100 days ago. We've got a lot of priorities. We've narrowed those down, 5 key priorities, all focused on profitable growth. And so I think you'll see us start to move away from some businesses that we may have been in and really focus our energy and our efforts on building profitable growth going forward. It's going to be a lot of fun.
And we're back. Okay, sentiment's come down a little bit. Fear and greed is neutral. National Association of Active Investment Managers is mid-range. Industrial earnings, top 30 weights down 1.54% in the last 60 days. E&P, which we've continued to stay away from with the exception of natural gas. We like Comstock Resources. Is a new position. We like that risk reward. These earnings are down 11%, but that's oil and gas. And for our view, not many of them have come down enough. X the nat gas pure plays moving forward. We're going to move right into the Ask Me Anything questions. Ite Naman asked, could you take a look at Neighbors? High operating leverage, focused on repaying debt and growing their lower capex, drilling solutions, energy transition segments, diversified geographically. Drilling is a tough business. I stay away from the drillers. The only one that I would get in that space is Schlumberger, and I don't think it's cheap enough for me here. So something like Neighbors. I'll take a quick look at it. But the thing I was a little concerned about was the balance sheet here. And I heard what you said about paying down debt and all that stuff. But, if you get drillers right at the right time and the right place, which was during COVID, it's a home run. This thing just looks like it's been deteriorating since 2008. I think they're going to have balance sheet problems when we look at it, if I'm not mistaken. Let's take a look here. Ugh, always logs me out. All right, here we go. Okay, so revenues are, got to get this smaller, not that small. Okay, revenues are reaccelerating. Let's see. Let's see if I can make this a little. There we go. That wasn't too hard. Okay. EBITDA is growing. That's just, I think this is just a solvency question. So they've got 400 million of cash and what was it, 3 billion of debt. Let's see. 2.5. All right, they are paying down debt, generating a lot of cash. Okay, so this is a low quality business. This would be a trade, if that. But what you have to figure out is when all of their debt comes due. So go into the public filings and figure that out. If it's imminent, you're going to have to make a determine how much is imminent and whether you want to take that risk. I just don't think the risk reward is good enough. I'd buy higher quality in the space, to be honest with you, but I can definitely understand why you got there. BTU, we've covered before. I don't like them, but no. And this thing's up 30 off its 30x off of its bottom. Someone already got the biggest bites out of that apple. That's not what I don't like scraps. I like to get the middle of it. I'm not going to get the exact bottom. I'm not going to get the exact top, but I want to take the core right out of the apple. And these type of things, just when they look like they're getting going, they've got these low PEs and blah, blah, blah. And then all of a sudden they screw it up. Every miner screws it up. That's like what they live to do in the most perfect environment and conditions. They figure out how to lose money. Let's see what BTU is doing. They're probably right in their beautiful spot where everything looks perfect, and then they screw it up. Let's see. So revenues are declining the last 12 months, but they're making, wait, I'm sorry. This is the balance sheet. Okay, so they got $1 billion of cash, low debt. Oh, maybe this is a cleaned up version because they already went bankrupt. So you might have a few more years before they go bankrupt again. Let's see here. Revenues are growing like crazy. Balance sheet looked okay. Cash flow is looking good. So. I mean, it's choppy. Yeah, Daniel, there are better places to make money. This goes in my too hard box. I don't think it's going to hurt you per se. But like, I hate businesses like this. It's 6 billion to 5 billion to 4 billion to 5 billion to 5 billion to 4 billion to 2 billion to 3 billion to 4 billion. I mean, what kind of a business is that? Like every year you're just like rolling the dice. Is this going to be, are we going to do 2 billion in revenue this year or 6 billion? Oh yeah, we know how we can plan on the basis of that. I mean, it's just, it's a garbage business. John Lee, hey Tom, what are your thoughts on Warner Brothers Discovery? Not interested. All right, let me take a look at it. My streaming play is Disney, okay? I like high quality in periods of dislocation. The lowest quality, these are leveraged trading vehicles. I keep looking at this thing and I keep passing. I know that I'm going to wake up and it's going to go from 10 to 30. That will happen. But there's also a decent risk. Let me take a look at the balance sheet and let me just figure out why I keep passing on it. Could just be instinct, but is that true? $44 billion of debt? Wait, you got to be kidding me. Let me see if that's true. My bet is that's incorrect. All right, let's take a look at revenues while we're here. Okay, they're growing. They must have done they did a big acquisition. EBITDA, balance sheet, $2 billion of cash. Yeah, $43 billion of debt. I mean, that's unbelievable. I mean, that just like, let's see if they're generating any cash. I don't know. I don't know about this. This is, I think you want to see where the bonds are trading more than anything else. That's going to tell you. By the way, interesting point on the bonds. I went to check out the Cooper Standard bonds that I could find, and most of them were trading over par. And the ones that had been lagging, trading at like 40 to 60 cents forever, I believe were up to 84 cents. So it looks like market is voting solvency is off the table. And if that is the case, that the market believes, the equity just has unlimited upside as the operating leverage kicks in. So I'm pretty excited about that. We actually added some for new accounts this week, so pretty excited about that. This is, I think you're just playing Russian roulette. You know, you basically you roll the chamber, and 5 out of 6 times you probably get a double or triple on this, but the one time you get your brains blown out. So I wouldn't play Russian roulette with $43 billion of debt when I could own Disney and get a double for sure over the next 12 to 48 months. I can't control when. It'll probably be sooner on this one, but I know why you're doing it. I think it'll probably work, but that's just too much debt for me right now. Okay. That's John. Michael Baxter, thanks for all the great content. From your experience, what's the longest and obviously undervalued, like Alibaba was sitting and doing nothing? Michael, we've covered this before. The most comparable that I've ever experienced is Range Resources, which is a gas play. We still own some. Nice size. We bought it down 90% at $11. It immediately rallied to 18, and then it crashed in COVID down to $1 and change. We used the opportunity. We brought our basis down to 410, and now it got up to 37. So it was a 9-bagger or 800%, and now it's $30. So what we have is now still an 8-bagger. 4 times 8, 7.7 bagger. But we do think this is going to work its way up to 60, and we'll probably take a bunch more off at that level. So what was this, 2018? So 6 years to get a 9-bagger. I'm perfectly comfortable with that. So if you're, they don't give away multi-baggers for free, but that's the longest one I've ever seen, and it looks like Baba's going in that direction. So, Baba could be, 36 to 48 months from inception, and then we'll wind up with a 3 or 4 bagger. That's perfectly acceptable for me, which is why we own 8 to 12 companies, because some take off like a rocket, like most of them, and some take longer. But the key is, if you're getting a 400%, even if it takes 6 years, that's a satisfactory, well above market net of fees IRR just for that 1/8 of the portfolio. Never mind the rest of them that act in a more in a quicker time range. So good question. I'm a loyal listener and reader of yours who's recommended you to many friends. Thank you very much, Martin. This is Martin Floriani, and has a high degree of respect for your detailed analysis and perspective. What are your views on General Mills? Held this stock since 2019, added to my position last year to see it decline from an all-time high of 90. Last time this happened was between 16 and 18, reversed well, has come down enough for present values. Lower interest. I like General Mills here. I think it's great. Let me just confirm that. This is another dividend pair. Now, I'm comfortable with General Mills here. Let me put it this way. I think General Mills, let's see, GIS. Okay. Yeah, it's got a 3.74 yield. This falls into that dividend bucket, which is out of favor now, which is going to stop being out of favor soon as the Fed starts cutting. And people have to look elsewhere for yield. This is just a steady, slow grower. I'm sure the balance sheet's fine. Let me just see if I pulled it up. General Mills. What's it trading at now? $63. Down from about 90. And the other beauty of this is they grow the dividend every single year. So most years rather. So if you lock in a 3.7 yield 5 years out, you've got a 5% yield on your basis, and you're probably up 50%, and you sleep well at night. This is a great company. They've got regular double-digit return on capital. They continue to buy in shares. I mean, you can't really ask for anything else. It's just straight up over time. Could it go down further before it goes up? Yes. So, I mean, I wouldn't load the boat, but you don't really have to think about it if you're not on leverage and you collect the dividend in the meantime. And sooner or later, 3 to 5 years out, this will be back over 90, and you have locked in a 5% yield. Even if it went to 50 before it went to 90, it doesn't really matter. And I think you're spot on. Interested in this is for client Bob Johnson. By the way, for clients, we're closing out the small account raise the end of this weekend. So if you want to come in at the $1 million, $1 to $5 million level, get in your inquiry and or subscription documents before Sunday, and then we'll close out until Q2 for the smaller accounts. For the larger accounts, the 5 and 10 million people, you get bespoke service. You can call whenever is convenient for you. Bob Johnson, can you take a look at Madison Square Garden Entertainment Group? This is a value trap that every single value guy from here to Sunday does the sum of the parts and says that all these things are worth 5x what they're trading at. And they're probably right. But it's not for me. I like a business that's compounding capital on a regular basis. I mean, let me just see here. I think this is mostly a real estate and hoping that the teams are worth more than they're supposed to be. It's kind of like the Atlanta Braves thing. What does this thing do? All right, so all right, entertainment business, sporting events, 70 inch. Okay, so they put on events. I guess it's produces, hosts live entertainment events. Yeah, for me, I like to see these business. For me, I just need years and years of operating history. So this is something for like a sum of the parts type of analyst. I like businesses that can compound free cash flow, and this one is a little bit more of a sum of the parts play. So I'm going to just pass. It probably works, but you got to go through the public filings, really understand the business, then value each piece on a standalone basis, and then determine whether if they liquidated tomorrow, you wind up with 3x or whatever, and then go for it. Jason Zen wrote me this long email. He had a long visit to China, and basically he said it's booming. So thank you for that. Ajit Al-Khandan, trust this message finds you and your family well in the new year. I'm writing to express my sincere appreciation for your insight and weekly podcast. Each episode consistently delivers valuable education takeaways. Find myself leaving with newfound knowledge. In light of the merger between Chesapeake and Southwest. I have a query regarding Comstock. Given the consolidation of their Haynesville shale assets, I'm curious whether this development poses a potential threat to Comstock's competitive advantage as the lowest cost operator within the sector. Alternatively, I may be oversimplifying the matter. Could it be that competitive moats hold less significance in the natural gas industry compared to factors such as PV 10 asset value, market cap relating, margin of safety? I'd be grateful for your insights on this matter. They sell a commodity, so there is no moat. It's just scale and cost of production and cycles in the market. So it has no bearing whatsoever. Kayla Smith, they're still the largest in Haynesville, by the way. Kayla is, what are your thoughts on Spirit Airlines? Save, it looks like it suffered a heart attack. Okay, so she sent this a couple days ago. Well, and when it was $7.80, well, now it's $4. So they announced a restructuring today. Part of that could be posturing with the government to get the merger with JetBlue back on. But if you had to buy a piece of crap airline, I'd buy JetBlue before I bought Save. So let's just leave it at that. And by the way, you don't have to buy a piece of crap airline. So take that for what it's worth. C asks, longtime listener, first time caller, take a look at Medifast. Medifast has historically been a up and down business, short sellers' wet dream, and then the shorts get squeezed, and then the shorts are right again, and then the shorts get squeezed, and then they're right again. So for me, this is let's take a look at it. I mean, this is Ozempic stuff. I don't really know. I mean, I can't predict what kind of impact Ozempic is going to have on, like, specifically a weight loss business. I know as it relates to the medical devices, I think that was complete BS, and that proved to be the case, and they were oversold. Same with Pepsi. People are going to still drink Pepsi and eat snacks. But on this weight loss business, if I can take a pill and lose weight and do nothing, I don't know how Medifast is going to perform. My guess is Medifast is for people who can't afford Ozempic. And but, you know, there's another pill that's been out since 2012 that was in Bloomberg. It starts with a Q, Qisima or something like that. It was approved for 12-year-olds. And that works almost as well, and it's like $250 a month, almost as well as the GLP-1s. Vivus makes it. So I'm not sure about this business. I mean, it looks perfect. By the way, I think this is a direct selling organization too. So that is an advantage. I mean, it's been a free cash flow machine. Yeah, I know what you're thinking here. Weight loss, weight management, healthy living products. So this is basically a vitamin company and meal company for people that want to lose weight, like Nutrisystem, shakes and pills and stuff like that. Like Herbalife, by the way, which is also a cash machine that's down quite a bit. That looks like this. So I don't know. Maybe I'd buy 2 of them as a hedge against Ozempic not changing the world as much as people think. But if it does change the world, you know, medical devices will do fine, but these type of shake and pill businesses, the other thing is people need protein when they're on these, and they still have to work out, and there's nutrition. So it's hard to say, you know. It's like this thing just came out called the automobile, and, you know, it's got 4 wheels, and you just turn the key and it goes, and you're like, well, but I've got this horse and buggy carriage. It works just fine. Like, no one can afford cars. Cars are too expensive, et cetera, et cetera, et cetera. Well, there aren't many people in the horse and buggy business. My instinct is that the Medifast and the Herbalifes and all these vitamin companies are actually going to rebound quite well and do exceptionally well, because people will become more health conscious as more people lose weight, and they'll get their share of the pie. But I can't really predict that right now. And if I could, Medifast probably wouldn't be my first choice in the group, despite the fact that it looks great, just because it's had there's just been a chronic interest from short sellers in this business over and over. And when there's that much smoke, sometimes there are issues. I just don't want to be in a business like that. So for me, Medifast is a pass. And my guess is you're right. And it's probably going to go immediately from 52 to 150 and leave us behind. But I'm willing to pass. That's just all I can say. Errors of omission are perfectly fine. Errors of commission, not so much. John Rass asks, when is the Hang Seng going to moon? I don't even know what that means, but it's going to go up when it goes up. Tom, when would you please give your thoughts on, we covered that. Paul Gertz, thanks for all you do. I was wondering if you could share some insight into how you read the news each day. You post your daily reads from various news sources, and it's also widely known that Buffett reads 5 or 6 newspapers a day. My question is, are you reading every article word for word? Are you just skimming for relevant articles and information? Would you guess to say Buffett is reading every page of each newspaper he reads? I can barely get through one newspaper in the morning reading every page, so I'm assuming there's some sort of method in reading them, or maybe you guys are just faster readers than I am. I do read a lot. But no, I don't read every article, and I don't read every word in every article. Like, for instance, today there was an article, Boeing got an order. All I need to know is who ordered it and how much. So that takes me, a half a minute to figure that out. A lot of the articles, I do read the whole thing, but I don't read every article. And I'll read every headline to find which articles I'm going to read. And most of the ones that I post, I do read some or all of the article. But that's, to get 10 key reads or 20 key reads, I scan probably 300 headlines to get the best 10 or 15 that I think I can make money with or that are exceptionally interesting to me, particularly on the weekends. I kind of go sideways on travel and cars and golf and other stuff that probably bores half of you to death. But during the week, it's all business all the time. Sam R., isn't the whole BABA thesis based around the CCP providing a big stimulus package to real estate companies? If they don't, I'm not sure how BABA will go up, as sentiment is based on the real estate situation. What sort of stimulus do you think will resolve that real estate problem? No, it's not, because they haven't done a massive stimulus, and yet they continue to grow cash flow per share, earnings per share, and revenue per share consistently. And this is what the thesis is predicated on. All that is an accelerant to the fire. I mean, if they do a huge stimulus, we get this now, okay? If they don't do this, meaning this arrow straight up to 200, if they don't do that now, it takes a little longer for everything to kick in post-COVID and for them to get their momentum back, and then it may be longer rather than sooner. I think the pain is acute enough they should act, but I can't handicap how people think that, have consistently done things against their own self-interest until they had no other options. So is he at the point where he has no other options other than to finally act within his own interest? I think he's at or close to that point, but he has been for 6 or 12 months. So I don't really worry about it. What I worry about is the revenue per share going up? Is the cash flow per share going up? Is the earnings per share going up? If those three things are taking care of themselves, I don't have to worry. Then it's just a question of when, and it's just a time arbitrage game. So no, it's not predicated on that. We would like that for an accelerant, just because we'd rather go to $200 or $300 now rather than later. But it's eventually going to catch up to its intrinsic value. And as it stands, there's been no evidence that the fundamentals are deteriorating. If anything, they have reaccelerated off the COVID lows and are continuing to grow sequentially. So we're pleased with that. Sophia Emma, hi Tom. There have been a lot of somewhat credible people talking about the existence of UFOs in the government's position. All right, I'll read this, but I'm probably not going to answer it. If true, what risk opportunities does that present? I mean, this is ridiculous. I have no idea. If they have UFOs, I don't think it's going to affect anything. If they're aliens, we probably have a lot more to worry about than cash flows and revenues and all that stuff. So, is there a UFO play? I'm thinking that's a joke. She's literally asking me about Lockheed Martin. So let me take a look at Lockheed Martin. sans UFOs and with UFOs. I appreciate you sending in a question, and I appreciate you being a listener. I don't know if Lockheed Martin has come in quite enough for me to get interested as a non-UFO or a UFO play, but it is a great business, and anytime you can get it down 25, 30%, that's something worth looking at. Right now, it hasn't come in enough because it's too great of a business. So if there are UFOs or they're not UFOs, I'm not interested in Lockheed Martin as of right now. So thank you for tuning in. We'll be back next week from Puerto Rico, by the way. Tomorrow's a busy travel week. I know I'm meeting one of you in Puerto Rico who is a potential client. If there's anyone else down in Puerto Rico who's either going to be at the conference, the SRAX conference that I'm speaking at, or you are an investor that listens to the podcast and want to meet while I'm down there, reach out. And then I will be in San Francisco for water polo. I think it's Walnut Creek, but flying into San Francisco in the latter part of the week. So from Monday through Thursday, I'll be in Puerto Rico, and from Thursday through Sunday, I'll be in San Francisco. Existing or potential clients that want to meet out there, reach out and we'll take it from there. So with that said, different place, probably similar time, but we'll see you next week at some point. Have a great one. Bye for now.